FIA FA1, Chapter 3, Part 9.6. Integrated Software. Welcome back, team. Today we are going to slow down and really understand one of the most powerful ideas in modern accounting systems: integrated software. I will keep the language simple and the flow clear, so even if English is not your first language, you can follow along easily. Imagine your accounting system as a small city. Each part of the city has a job. One area sells goods, another keeps stock, another pays salaries, another prepares reports. In a non-integrated world, people would carry paper from one area to another, repeating the same information many times and making mistakes on the way. Integrated software is like building fast roads and smart traffic lights between those areas. When you enter information in one place, the software passes it automatically to the other places that need it. You enter once, and the system updates everywhere that is relevant. No retyping, no delays, fewer errors. The heartbeat. One action creates many correct updates. The FIA FA1 book gives the sales example, and we will make it very concrete. You create a sales invoice in the invoicing area. The moment you approve that invoice, several things happen without you entering the details again. First, the customer's balance in the receivables area increases by the invoice amount. This is the system posting the invoice to the customer's account so you can see how much the customer owes and when it is due. Second, the inventory area reacts. If the invoice releases goods, the quantity on hand goes down and the value of stock reduces. The software also writes a tiny movement story. So later, you can see that these units left the store because of this invoice on this date. That movement story is your audit trail inside inventory. Third, the general ledger receives the double entry automatically. Sales income goes to the correct sales account. Cost of goods sold is recognized if your system is set up for it, and stock reduces accordingly. You did not type any debits or credits by hand. The system used its rules to do it for you. Fourth, if the sale belongs to a project or job, the job costing area records the revenue against that job. Later, when you look at profitability by job, this sale is already in the right place. Fifth, the reporting area is quietly updated. The sale joins today's totals, this week's analysis, and this month's performance. When the manager asks for a sales summary, the numbers are already there. No extra work. One action. Many correct consequences. That is integration. Explaining the integrated accounting system diagram, rich descriptive walkthrough. Let's read the diagram as if it were a story happening inside your accounting system. In the middle of this story stands the general ledger module. Think of it as the brain and permanent memory of the business. Every important financial event is finally written here as a clean double entry. One debit and one credit. Nothing is official until it lands in the general ledger, and every other box in the diagram is either feeding it information or drawing summarized information from it. Begin on the left with the receivable module. This is where the business keeps the running history of each customer. Invoices raised, credit notes issued, payments received, and amounts still outstanding. The instant a sales invoice is approved, the receivable module increases the customer's balance and sends a posting to the general ledger. The brain then records a debit to receivables and a credit to sales income, and to sales tax if the system is configured to do so. If that invoice relates to a specific project, the same document can also notify the job costing module so the revenue is recorded against the correct job. Later, when the customer pays, the receivable module reduces the balance and again sends a posting to the general ledger, so cash and receivables move in step. In short, receivables keeps the fine detail by customer, and the general ledger keeps the totals that appear in the financial statements. Slide one box to the right and you meet the payable module. This is the mirror image for suppliers. When a purchase invoice arrives, the payable module records the supplier, the due date, any early payment discount, and the amount. At the same moment, it pushes a posting to the general ledger. a credit to payables, and a debit to the correct expense or asset account. If the purchase belongs to a project, the payable module also notifies the job costing module so that materials or subcontractor charges are assigned to the right job. When the bill is paid, the payable balance drops and the general ledger reflects the cash outflow automatically. Again, detail lives in payables. The official totals live in the general ledger. Now look at the payroll module. Here the system calculates gross pay, taxes, pension contributions, and the final net pay for each employee. When payroll is posted, the module pushes several tidy entries into the general ledger at once. Wages expensed to the appropriate cost centers, liabilities for tax and social charges, and a reduction in cash when salaries are paid. If staff worked on projects, the payroll module also passes labor costs to the job costing module, so each job carries its fair share of labor. This dual link, general ledger for statutory reporting and job costing for managerial analysis, is a pattern you will see again. Move further right to the inventory module. This is the live record of quantities and values held in stores or finished goods. When items are received from a supplier, inventory increases and the valuation is updated. When items are shipped to a customer, inventory decreases and the cost of goods sold is recognized. Those movements create automatic postings into the general ledger, so stock and cost of sales stay correct without manual journals. When materials are issued to a project, the inventory module also hands the material costs to the job costing module. In this way, the same document simultaneously updates stock numbers, job costs, and the accounting books. On the far right sits the non-current assets module, often called the fixed asset register. It stores the lifetime story of each long-term asset, the purchase date, cost, useful life, depreciation method, improvements, and disposal details. At month end, this register calculates depreciation and pushes the required entries to the general ledger, debiting depreciation expense and crediting accumulated depreciation, so both profit and asset values are up to date. When an asset is bought or sold, the register posts the acquisition or disposal entries to the general ledger and keeps a clear audit trail of the transaction. Return to the lower center and focus on the job costing module. This module does not replace the general ledger. It sits alongside it to answer a different question. How profitable is each job or project? It collects revenue from the receivable module when project invoices are raised, collects labor from payroll, collects materials from inventory, and collects subcontractor or service costs from payables. Because all these flows come from the operational modules that actually create them, job costing has a complete, real-time picture of every project without anyone retyping the same numbers. If your business recognizes work in progress, the job costing module can also generate journals back to the general ledger, so unfinished work is valued correctly at period end. Above the general ledger, you see spreadsheet facilities with a two-way dashed connection. This shows a controlled bridge for analysis and planning. Actual results can be exported from the general ledger into a spreadsheet for modeling, charts, and ad hoc analysis. Budgets and forecasts prepared in the spreadsheet can be imported back into the system, becoming targets that your reports compare against. Feeding those spreadsheets are two management layers. The decision support system, which helps finance and managers run scenarios. What happens to profit if sales fall by 10%? And the executive information system, which presents high-level dashboards for directors who need quick summaries rather than transaction detail. The crucial point is that both management layers draw from the same single source of truth, the general ledger's posted figures. Link everything together in a single flow and the picture becomes simple. You issue a sales invoice. Receivables updates the customer. Inventory reduces if goods are shipped. Job costing recognizes revenue if a project is involved. And the general ledger receives the official double entries for all of it. Later, you receive a supplier invoice for materials. Payables updates the supplier. Inventory increases if stock arrived. Job costing picks up the material cost for the job. And the general ledger records the liability and the asset or expense. At month end, you run payroll and depreciation. Payroll and the asset register each push their journals to the general ledger, while job costing absorbs labor for projects. At any moment, spreadsheets and management tools can pull accurate, up-to-the-minute numbers from the ledger without anyone rebuilding data by hand. Two final ideas make the integration safe. First, the system uses shared master data, one customer list, one supplier list, one item list, one chart of accounts, so every module speaks the same language. Second, every automated posting keeps a clean audit trail back to the source document and the user who created it. That means a manager can start at a total in a report, click to see the general ledger entries, click again to view the originating invoice or payroll run, and understand exactly why the number is what it is. If you remember nothing else, remember this. The general ledger is the hub. Receivables, payables, payroll, inventory, and the asset register are the spokes that feed it. Job costing gathers operational costs and revenues across those spokes. And spreadsheets with decision and executive systems sit above, reading trusted numbers from the same hub. That is how an integrated accounting system keeps every part of the business in step, fast, consistent, and audit-ready. What makes this work behind the scenes? For integration to feel magical, a few building blocks must be in place. The first is shared master data. Customers, suppliers, inventory items, tax rates, account codes, and job codes must exist once in a common place and be used by all areas. If the customer is called Ali Limited in receivables, the same name and code must be used by invoicing and the general ledger. Shared master data avoids confusion and duplicates. The second is posting rules. The software needs rules that say, for example, when a sales invoice is approved, credit the sales account, debit the receivable, reduce inventory, and charge cost of goods sold. These rules are configured when the system is set up. You do not see the equations. You simply choose the correct document and the system follows the rules. The third is real-time or scheduled timing. In many modern systems, updates happen instantly the moment you save a document. In some systems, updates happen in short batches, for example, every 5 minutes, or when you press a post button. Both are still integration. The difference is only timing. The fourth is a clean audit trail. Every automatic movement keeps a link back to the original document and the user who did it. Later, an auditor can click from the ledger back to the invoice, from the inventory movement back to the dispatch, and from the report number back to the list of transactions. Nothing is mystery math. It is traceable. Walking through the main integrated flows. Let's narrate a few everyday flows so you can see integration in action. When you record a credit sale, the invoicing area produces the document. Receivables increases by the total. The general ledger records the income and the tax. Inventory and cost of goods sold adjust if goods are involved. The job costing area receives the revenue if a job was selected, and the reporting area refreshes sales dashboards. When you record a purchase invoice from a supplier, the payables area increases by the amount you owe. The general ledger records the expense or the asset. Inventory increases if goods came in, and the cash flow forecast updates because a payment will be due on the supplier's terms. When you run payroll, the payroll area calculates gross pay, tax, and net pay for each employee. The general ledger records wages, expense, and the liabilities for taxes and contributions. The payables area can hold the amounts due to the tax authority. And management reports update staff cost by department or job. When you add a non-current asset, such as a vehicle, the asset register stores its cost, life, and depreciation method. The general ledger records the asset and later posts monthly depreciation, and the reporting area shows asset values by category. If the vehicle is used on a specific job, the job costing area records usage or recharges. When you issue a credit note or process a return, the same integrated road works in reverse. The receivable reduces, inventory increases if the item comes back, sales analysis updates to show the return, and the general ledger posts the correcting entries. Because all pieces are connected, the system keeps your balances consistent, validation, controls, and error handling in an integrated world. Integration is powerful, but it must be safe. That safety comes from validation at the input stage and controls across the system. Required fields such as date, customer, item, quantity, and price are enforced so important information is never missing. Formats are checked so codes are correct. Ranges are checked so quantities and dates make sense. These checks reduce garbage in, because garbage in would become garbage everywhere once the data flows. User permissions keep sensitive areas protected. Someone in sales can raise invoices but may not be allowed to change the chart of accounts. Someone in payroll can see salaries but cannot view customer prices. Integration shares data, but permissions control who can see and do what. If something goes wrong, for example, you chose the wrong customer, systems provide reversals or document corrections. Because of the audit trail, the correction is linked to the original, and all integrated areas are updated again, so balances remain right. At period end, accountants still perform reconciliations. Integration reduces manual work, but professionals still check subledgers to the general ledger, review suspense accounts, and confirm that the numbers tell a consistent story. Integration with spreadsheets and decision tools. The book mentions links to spreadsheets and to decision support or executive information. In practice, this means your integrated system can export clean, up-to-date figures into a spreadsheet for deeper analysis, budgeting, or charts, and it can feed summary dashboards for managers. The important point is that the data in those tools is pulled from the same single source of truth, not typed again by hand. Common benefits you will feel day to day. You save time because you enter once and the system does the rest. You gain accuracy because the same numbers flow everywhere without rekeying. You see reality sooner because reports update immediately. You work with confidence because you can click from a report to the underlying entries and then to the original document. And you collaborate better because sales, purchasing, warehouse, payroll, and finance are all looking at the same shared information. What to remember for your exam and your job. Integrated software means connected modules. An action in one module automatically updates other relevant modules, such as receivables, inventory, the general ledger, job costing, and reporting. The sales example in the book is the perfect illustration. Create and authorize a sales invoice, and the system posts to the customer account, reduces stock, and records the movement, records the sale in the general ledger, updates the job if one is selected, and refreshes sales totals for management reports, all from that single, well-validated input. When you understand this flow, you understand why modern accounting is faster, cleaner, and more reliable. Integration is not decoration. It is the engine that keeps every part of the accounting city moving in sync. All right, let's go deep into the advantages and disadvantages of integrated accounting software from FIA FA1, Chapter 3, Part 9, Point 6.1, and Point 6.2. But I'll make it extra clear, highly descriptive, and beginner-friendly so that every point is understood in context. Advantages of integrated accounting software. Integrated accounting software is designed so that all the different parts, modules of the accounting system, such as receivables, payables, payroll, inventory, and the general ledger, are linked together and work as one system. This creates a number of major benefits. 1. Single entry updates. Multiple ledgers automatically. In a traditional, non-integrated system, you might have to enter the same transaction in several different ledgers. For example, if you sold goods, you would enter the sale in the sales ledger, update the customer's balance in the receivables ledger, adjust inventory levels in the inventory ledger, and record the totals in the general ledger. With integrated software, you only enter the transaction once. For example, raising a sales invoice in the receivables module, and the system automatically updates all other relevant ledgers. This eliminates repetitive work, reduces errors, and speeds up processing dramatically. 2. Powerful automatic reporting. Integrated systems store all related data in a connected way, which means the reporting function can pull information from all relevant files at once. Instead of you manually collecting figures from multiple places, the software can instantly produce accurate reports. For example, an income statement, an aged receivables report, or a project profitability report, by pulling live data from all the connected modules. This is especially valuable for managers who need quick answers, auditors who want complete information, or business owners who need real-time insights for decision-making. 3. Reduced workload and smoother operations. Because transactions only need to be entered once and reports are generated automatically, the workload on staff is much lighter. In older systems, users had to load and unload disks or move between separate programs to perform different tasks, which was slow and frustrating. An integrated system eliminates this, meaning less wasted time and more focus on productive work. It also reduces the stress of remembering to update every ledger manually. The system takes care of it for you. Disadvantages of integrated accounting software. While integrated systems offer many benefits, they also have some drawbacks that need to be considered. 1. Higher memory and storage requirements. Integrated systems require more computer memory than separate, standalone programs. This is because the software contains all modules, receivables, payables, inventory, payroll, etc., in one package, even if you don't use all of them. On older or less powerful computers, this could mean slower performance or less storage space for actual data. In modern cloud-based systems, this is less of an issue, but it's still relevant for businesses with limited IT infrastructure. 2. Risk of being a jack of all trades, master of none. Because one integrated program is expected to handle everything, there's a chance that it may not do every single task as well as a specialized standalone program. For example, an integrated payroll module might be less flexible than a dedicated payroll software, or its inventory module might not have all the advanced features of a specialist inventory system. This is sometimes summed up by the phrase, open quote, jack of all trades, master of none. In other words, you get the convenience of everything in one place, but you might lose the depth and customization of specialized software. Close quote. Final summary, integrated accounting software is like having all your accounting tools under one roof, sharing information instantly and reducing repetitive work. It shines in speed, accuracy, and reporting, but it demands more computer power and may sometimes lack the advanced features of standalone specialist systems. For many businesses, the advantages far outweigh the disadvantages, especially when efficiency, accuracy, and real-time information are priorities.